We're going to be talking about best practices in portfolio management and also the business. And we touched on this a little bit, the business of investment management. We all of you manage portfolios or do research, but it's still a business of investment management, and there's a lot of aspects to it. So we're going to touch on that and ask the panelists about their philosophy of how to meet client needs. So again, I'll ask each of our panelists to introduce themselves and their firm and their role there and their background. Jack?
Okay. My name is Jack Perkins, and I'm the chairman of the City of Boston Pension Fund. This pension fund covers all the employees of the city, 42,000 active employees, and 16,000 retirees. The size of our fund is $4 billion. We've been investing for many years. It's one of the oldest pension funds in the United States. The moment we have the way our investments are broken up, we have 54% in equities, 24% in fixed income, and 22% in alternatives. The alternatives are broken down into 10% real estate, 7% hedge funds, and 5% private equity and venture, about to be increased to 7%. We've done pretty well over the years. We have an actuarial assumption of 8% that we need to maintain. We've been doing pretty well until 2008. And the big thing about public funds is the funding liability. It's very important. We keep an eye on that. Our fund is about 70% funded. Might sound terrible to corporates, but for public funds, it's not too bad. Based upon an 8% actuarial assumption, we would be fully funded in the year 2024. And that was thrown off because of 2008. So it's hard to figure that out at this point.
My name's Arup Datta. I'm part of the 5-member management team at Numeric Investors. For those of you who don't know Numeric, we have been in business since 1989. We manage about $11 billion in equities all over the world. It's all done quantitatively, as the name Numeric suggests. I myself have been there 18 years, and I head up the portfolio management side at Numeric. So as a quant shop, we have done various things over the years for clients, except enhanced indexing or indexing. So we have done everything in the active space, from active long only to 130/30 to market neutral long short hedge funds. And we continue to do all of those investments today.
Kevin?
Good morning. My name is Kevin Divney. I'm Chief Investment Officer of Beaconcrest Capital Management. We're a new firm founded here in Boston 1 year ago. We launched our first hedge fund last October. Our philosophy is to blend quantitative and fundamental stock selection techniques in a risk-controlled way. And the focus of the fund is to preserve capital and deliver about half the volatility of the S&P 500 to 3/4 over time. I think the characterization of what we developed is what's been termed a classic hedge fund, in the fact that we don't use a lot of leverage. We can be market neutral, but we also can be net long and net short within certain parameters that we've discussed with our client base. The philosophy has really been born out of an experience that I've lived through, seeing periods of extreme effectiveness and not very effective techniques, both in the quantitative and fundamental side. So I hope we get into that in the discussion today. And what we're really trying to do is mitigate the weaknesses of two approaches and amplify the strengths by blending them together.
Great. Thank you, everyone. So the best practices. Let's talk about best practices. And Kevin, I know that you began talking about what do you think the best practice today is, and you've started your new firm to implement that. So very few of us get a clean sheet of paper to start from and to implement what we think are the best practices. So I think it's very interesting to hear what your philosophy is on that.
Well, part of it is personal and client experience, and having run long-only mutual funds and ERISA money for 15 years prior to this, multi-billion-dollar strategies is, not just 2008, but the last decade, it was very painful for people. You can measure different ways and say you had 20% vol with no return. And so I think a way to preserve capital, and as someone mentioned in the last panel, the pain of loss is 3 or 4 times the pain of gain. So I think people, both institutions and individuals, are willing to give up the 8th and 9th inning in a trade if they can get the first 4 or 5 innings and not have those massive drawdowns. And personally, I just think as an industry, we're at this inflection point where the traditional approaches calibrated towards 12% return assumptions in U.S. equities, which that was my belief 10 years ago after 2 decades of a bull market, and that's baked into asset allocation models, that we have to think about asymmetric risk profiles, and that really has to drive what we're going to do for our clients, and more importantly, we have to make sure our own money is right alongside what the clients are investing with us.
I mean, that's definitely a best practice, or at least a common practice in the hedge fund world, that portfolio managers have a lot of skin in the game. Do you think that's going to be more prevalent in the more traditional institutional asset management?
Yeah, I think there's certain legislation out there for disclosure. I know in my former firm, we used to have in the prospectus for a while what we had in the fund. I think that's very important. It was also eye-opening. And I think there was some rationalization at some point where people would say, well, if you manage this type of strategy and maybe that's not good for your retirement, there's too much risk, you don't have to put as much money into it depending on the asset class. I think that's unacceptable, because how can you sit across from your client and say, commit your capital to me, think long term, unless you're willing to put your money aside from it. And that, I think it influences decision making in the long run, but it also, the preservation of capital becomes sort of a driving theme in your day-to-day decisions.
It will if that's your mortgage payment, certainly.
And you're not really focused on just the competitive performance, because if you're down 17% and the market's down 22 and you're Lipper 14th percentile, you get paid. Your client still lost 15% of their capital. So that's, I think that's a transformative thing right now we have to sort of really look in the mirror and think about.
Jack, do you consider manager participation in the funds when you're looking at a new manager?
No, we don't, except in private equity.
Okay.
But in equities, fixed income, we don't.
Interesting.
Or hedge funds.
Mm-hmm. Even in hedge funds, that's interesting. Arup, your opinion on that?
Sure. Talking about best practices, in my view, it all starts at the firm level. Though I was not the founder at Numeric, I've been there 18 years, and many things I say right now have been ingrained in me over the years as I've been at Numeric and managed it with others over the last few years. I would say it's very important how the firm is built. In my view, being an asset gatherer is not the best for clients such as Jack. I would say a lot of firms have built their business that way, and that's not something we have strived to do. So firstly, we are very much more investment focused, and the easiest way to figure out is look at the number of people on the investment side versus the number of people in marketing or client service. And if that ratio is skewed one way or the other, you know where the focus of the firm is. So that's one thing, and we obviously build our focus heavily on the investment side in terms of number of people there, because I think that's what drives the alpha, which is what the clients hire us for. How much did we beat whatever bogey the client set up for us? We also have had a long-standing mantra which says no alpha, no business. So if there's no alpha, clients will leave you ultimately. You can only keep them for so long. So therefore, the focus has always been on alpha. On the second point, this is where I might differ with Kevin, is we have tried to be more different products to different clients. We do not claim that we know all the clients' needs. Some clients, such as Jack's, figuring out from your $4 billion portfolio, have various buckets he needs to fill. There are others, this is a one-stop shop, we need everything through this one manager. So we've tried to address all of those by having products all the way from active long only to meet people's large cap growth bucket or so on, to all cap products, and then 130-30 and finally market neutral or long short products. So we let the client decide which of our products they decide they want, and then we talk to them on that. So we have been basically diversified in terms of our product offerings, and I almost look at that as lower alpha to higher alpha in that spectrum of things. In terms of portfolio management, even though we are a quantitative shop, we have always believed in a hands-on portfolio management approach. So the portfolio managers such as myself do spend 2 to 3 hours every morning making sure every data that drives the signals which decides how we pick stocks is all clean before we invest. We don't have a set of fundamental analysts, but we are the final check before we actually buy your names. So I would say this is a combination of mostly a quant process and a human overlay which takes into account and cleans out any data issues or anything else that could be going on, like the Gulf oil spill. And based on that, maybe all of the offshore drillers are moving up your rankings. Obviously, there's something there you might be missing in your process. That's where the human overlay has to step in. And lastly, we have always focused on alpha but kept risk in mind. So it's a risk-adjusted alpha process. But that's what has helped the firm over the last 21 years.
Thanks. Arup brought up something interesting in that clients like Jack often have holes to fill in their portfolio, and having multiple products to fit those can win business. And I think you balance that with the overall philosophy that Kevin, you had spoken about of capital preservation. There may be, is there a fundamental conflict between capital preservation and a specialized product to fill a hole in a portfolio, multi-manager portfolio?
I think not, because in my comment, the context of I never want somebody to invest in our fund only. It's part of a broader asset allocation. And I think that one thing, it's very important to understand your client's asset allocation expectations and where you fit in that, because what you don't want to do is exacerbate or amplify other bets that they're making. And so if they come to us for something that, our equity weighting is 60%, but as was mentioned earlier, I agree, we add a long short manager to that equity allocation, maybe we kind of bring that down. So, it's the manager also has to, even in, the hedge fund space, or as it is in the mutual fund space, you have to stay in the geographic area where you said you're going to generate alpha from, because your overall client allocation, whether it's individual or institution, they're making another decision. So that asset allocation decision is theirs, but you need to understand how you're fitting in that and what you may do to amplify or offset things that they're trying to achieve.